Hey YouTube, welcome to OMFG, the weekly personal finance channel for you crazy Canucks.
If you remember our video about credit cards, we briefly touched upon credit scores and credit checks when you apply for a credit card.
In this video, we're going to go over exactly how your credit score gets affected, the 5 factors that affect your credit score, and how to improve your credit score.
Let's start off by explaining what your credit score is. Think of your credit score as a numerical value that rates how reliable you are and credible you are when paying off your debt. The credit score ranges from 300 to 900 points, and the higher the better. You typically want to aim to be over 750 points.
Credit scores are important because they affect more than just applying for different and new credit cards. For example, when you apply for a phone plan, line of credit, insurance, landlords may use them to determine if you'll be a good tenant, and of course, getting loans and mortgages. Having a bad credit score may compromise getting a good rate and whether you'll get approved for these things.
So what makes up your credit score? The credit score is based off of 5 different categories. The first and most important category is payment history. The payment history is based on how often you pay it in full and on time. The loans that are covered in this is not necessarily only credit cards, but also your phone bills, your car loans, any other loans you have, and your mortgages. What's most important about this is that you pay everything on time and you don't just pay the minimum balance on your credit card statements if you want to keep your credit score up.
The next biggest category is something called the amount owed. Amount owed factors in something called credit utilization. Credit utilization is essentially how close you are to your total credit limit. This can get really technical and we don't want to bore you with the technical details, but what you can take out of this is that it's a good idea to avoid creeping up to your total credit limit. As a general rule of thumb, we advise staying under 50% of your total credit limit.
Next is history. This is the exact reason why people say to keep your old credit cards. Now think of your history like your school transcript. Whenever you keep up with your bills and you pay them on time, your GPA or your credit score could go up. Now if you cancel that credit card, your transcript could be lost forever. It's not necessarily bad to have a new credit card as long as you make sure that you keep up with the bills and you pay them on time.
Credit products is a little weird to us. This factors in different types of credits you have, like lines of credit and mortgages. And the reason we find this weird is because it's almost promoting for you to go for different types of credit. The reasoning for this though is because the credit companies want to see that you're responsible with paying off different types of credit. We want to emphasize though that this does not mean go ham and apply for 10 different types of credit cards. Please don't do that, guys. It's only going to end terribly. But we also understand that this only accounts for 10% of the requirement, so we would recommend don't stress about this requirement too much.
The final category is new credit. As we mentioned in our credit card video, every time you apply for a credit card, you get hit with a credit check. If you do get denied when you're applying for a credit card, it's probably best to hold off applying somewhere else until your credit score goes up. The reasoning for this is because you're seen as more risky to the lenders when you're applying for more credit cards in the same time frame, because you may be in a bad situation and looking for more credit. There is an exception for this, and it specifically applies to mortgages. It's probably best off to shop for mortgages within a 30-day time frame so that all the hard credit checks are seen as one big one instead of multiple sequential ones, which could affect your score greatly.
There are 2 types of credit checks, hard checks and soft checks. A hard check is performed when you apply for different types of credit like we mentioned above, like your car loans, your mortgage, or your credit cards. A soft check, on the other hand, is something like checking your own credit history, or even your credit card company might do something like a soft check to offer you something like increasing your credit card limit. The point is, a soft check doesn't affect your credit score much. We recommend checking your credit score once a year or before applying for that major credit like a mortgage or car loan.
If you're wondering how you can check your credit score, you're actually eligible for an annual free credit report from TransUnion or Equifax. Or, if you're willing, you could pay for their monthly service where you could check your credit score online at any time. Another increasingly popular option is Credit Karma. They'll provide you a free credit check whenever you want. We will provide all this information below.
So you want to improve your credit score. If we go back to our credit score breakdown, we can see that payment history and amount owed account for 2/3 of the breakdown. So this means as long as you pay your bills in time, and as long as you pay them in full, and as long as you stay under 50% of your total credit limit, you should be fine. For the most part, the rest of the categories will kind of take care of themselves if you do the 2 things we just talked about right now.
We hope we answered all your questions about credit scores. Do you have any additional tips or questions about credit scores? Or do you have any other topics you want us to cover? Let us know in the comments below.
Don't forget to click that like button on this video, and if you like what we do, please subscribe. It's the only way we'll know that we should be making more videos just like this every week for you.